Rio Can, one of Canada's largest REITs, is perfectly positioned to benefit big time from falling interest rates. Fasten your seatbelts, folks. This is going to be a good one. A real estate investment trust, or REIT, like Rio Can, is a company that owns, operates, or finances income-generating real estate. REITs offer a way to invest in real estate without, well, all of the headaches of managing properties ourselves. You may ask, what exactly is making RioCan and REITs in general the hot investing topic of the day? Well, it has everything to do with interest rates. Interest rates play a huge role in the real estate market, from property valuations to the borrowing costs that REITs face. Typically, REITs don't do well in an environment of rising interest rates. This is because higher rates increase the cost of borrowing for REITs, which generally carry a lot of debt as it is. Increased borrowing costs can mean lower profitability, and in turn, that leads to reduced total returns for the investors. The good news is that we have entered a rate cut environment, and REITs love that for sure, as it totally flips that scenario. Lower interest rates mean reduced mortgage expenses for REITs, allowing them to manage their properties more efficiently. Rio Can, for example, has a significant portfolio of retail and mixed-use properties across Canada. And as rates drop, they can refinance their debt at lower rates, significantly boosting their profit margins. Of course, that's not all. Lower interest rates also makes it more affordable for buyers to purchase property, leading to increased property valuations. This is excellent news for REITs, since the value of their portfolio could go up, which directly impacts the value of the REIT itself. Finally, in a low-rate environment, the yields provided by REITs stand out quite a bit more. With lower rates on bonds and GICs, investors start looking for better income-generating alternatives, and REITs with their steady distributions become a very appealing choice for sure. RioCan has strategically shifted their portfolio over the years, moving from primarily retail assets to include a growing number of mixed-use developments. This diversification not only protects RioCan against, well, economic downturns, but also positions them well to take advantage of Canada's growing urban residential demand. In a rate-cutting environment, RioCan's ability to secure cheaper financing could supercharge their mixed-use projects, making residential towers, office spaces, and retail properties more valuable. Lower rates means RioCan can more aggressively pursue new developments, modernize existing properties, and capture more income streams from different tenant bases. This is all good news for investors for sure. When you sub to the channel, you get an investment in future content that thrives in all rate environments. We will be using RioCan's Q2 report for this deep dive. Thus, the data is up to date as far as, well, June 30th, 2024. Of course, we do have some data, such as the returns, that is up to date of the time of recording. Now, looking deeper into that report, there are some pretty nice highlights in there that I definitely want to include. Their committed occupancy rate is currently coming in at 97.5%. This is a strong indicator of stability, as a high occupancy rate means most of their properties are leased, and that means they're generating consistent rental income. This level of occupancy is particularly important in a rate-cutting environment, where stable cash flow is crucial for refinancing opportunities and future growth. The report also highlighted that RioCan owns a portfolio concentrated in prime, high-density, transit-oriented areas in Canada's major markets, which of course ensures stable tenant demand. Retail committed occupancy is 98.3%, and recent leasing spreads are at record highs, including a 52.5% spread for new leases, showcasing strong rental growth potential. Finally, about 87.9% of their rent comes from strong, stable tenants like Loblaws, Sobeys, and Dollarama. That ensures a reliable income stream even during economic uncertainties. I am loving the information that I've seen thus far, and it is hard not to be bullish in a rate-cutting environment. However, as always, we do have to put aside all of the fluff and jump into the universal language of numbers. If we're about to crunch some numbers, we need to call on the sage of subtraction, the baron of balancing, the one and only Mr. Math. As usual, we will begin with a little surface data. At the time of recording, their current value is coming in at $19.77. They have a market cap of $5.93 billion, Their beta 1.31, so they are a little more volatile than the market average. Their earnings per share coming in at 0.20. I do expect this number to be up for sure in the next few quarterly reports. As this is a REIT, instead of a price to earnings ratio, we will look at their funds from operations, as this is a much more usable stat. We will also use their funds from operation payout ratio when we get to the dividend. So their funds from operation comes in at 43 cents per unit. They've got a price to book ratio of 0.80. The average amongst their peers, 1.30. Their return on equity, a little bit low, 0.78%. Return on assets, 2.88%. Overall, these numbers are reflective of the rough time REITs have been through, and we will for sure see huge improvements by the end of the year. Okay, let's go a little deeper and check out their cash data as well as their fair value. Their revenue comes in at $1.23 billion. Their earnings coming in at $59.79 million. Now those earnings, they are projected to grow by 41.5% per year over the next 5 years. Their profit margin coming in at 4.9%. Free cash flow, $360.29 million. Exact same number for their operating cash flow, another $360.29 million. When we look at fair value, their current value, once again, $19.77. Their fair value via a discounted cash flow model comes in at $23.20. So that does paint them as being undervalued by 15.5%. Analysts have a 1-year target of $21.45. That is an increase of 9.4%. I absolutely suspect this target may be low. It is another data point I want to see on their Q3, or actually, more importantly, those Q4 earnings. Let's pull back another layer and take a gander at their dividend and returns data. They have a dividend yield of 5.663%. That is a monthly dividend of 9.2 cents per share. The funds from operation payout ratio, that comes in at 61.5%. In a nutshell, an FFO payout ratio between 50 to 80% is generally considered quite good for most REITs. Their 5-year average dividend increase, it is in the negative 4.67%. They did cut that dividend in the pandemic, down from 12 cents to 8 cents, but once conditions improve, they have begun to raise it again. On their 3-year return on investment, that comes in at negative 10.58%. Factor in the dividends, we get a total return of 3.74%. We can clearly see the bear market and the aggressive rate hikes playing out in this data. Of course, powered by those rate cuts, their 1-year return on investment comes in at 18.81%. Total return after we add in the dividends, 24.33%. Absolutely, this 1 year does provide the beginnings of the rate cuts, which of course began in June. We have one last set of data to check out. So let's dive into their debt data. So their total debt is coming in at $7.14 billion, and their total equity sitting at $7.52 billion. This gives us a debt to equity ratio of 95%. Their debt to equity ratio has increased from 79.6% up to 95% over the past 5 years. So they are definitely moving in the wrong direction. However, this is not surprising as they have had a rough few years, and I do suspect we're going to see this do an about turn in the next 5 years. Their cash and cash equivalents, that's coming in at $50.81 million. Looking at their short term, they have assets of $489.72 million, and their liabilities a little bit high, $1.65 billion. Of course, I would much rather have seen our assets overtake the liabilities, but considering what REITs have been through, this is not bad. On the long term, their assets are coming in at $14.73 billion. Liabilities at $6.05 billion. That's better. That's much better. That's what I'm talking about. Overall, their debt situation could have been much worse. It may not be ideal, as of course their debt is not well covered by their operating cash flow, and the servicing on that debt is not well covered by their EBIT, so those earnings before interest and taxes. However, considering the bear market, considering the aggressive rate hikes, this could have been much worse for sure. I suspect this new rate cutting environment is going to be very good for their future debt data. Let's take a look at share dilution. In this case, we really don't have any significant share dilution. That's fantastic. Let me also add that in the last year, there's been much more insider buying to the tune of 29,475 shares compared to insider selling of a measly 4,886 shares. So obviously we can definitely paint the insiders as being a little more optimistic on where this company is going. With that being said, I do think we have enough information to bring together the final verdict. RioCan and most REITs are in the same boat as they ride that wave of rate cuts into a recovery sunset. I am expecting the recovery to stretch through 2025, and that means a lot of opportunity for investors. This recovery will amount to very nice total returns, and for that reason, I do think they will be a prized part of many portfolios. On the other side of recovery, we should be moving back into more of a rate equilibrium with the occasional hike and the occasional cut, which will level out RioCan. This, of course, means that they will move from being less of a total return generator and more of a steady income generator. For at least the next year, I do think this is a great stock for most portfolios, save perhaps the pure income portfolio, which may seek higher pastures. Of course, there are some great ETFs for those folks for sure that may tickle the need for yield. Once the growth is over in 2026, you may want to reevaluate how you position the stock in your portfolio. I still think it'll be a great stock. It's just not going to be a great total return stock at that point. If you are interested in RioCan, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Well, let's continue that learning journey by checking out this video on REIT ETFs. Thank you for watching, and I will see you in the next video.